We have lots of big news to go over in this video, but let's start with what Tom Lee just said about our major event this week, which is Fed Jerome Powell at Jackson Hole. Tom Lee and Fundstrat say Fed Chair remarks at Jackson Hole are likely to solidify that August 5th was the summer low. This coming week is the most important week for August 2024 because of the Jackson Hole Symposium, and Fed Chair Powell speaks at August 23rd. Last week, on August 13th, we noted that markets shifted to risk on, premised on a benign CPI. In 2021, the headliner was markets sink after Powell says fighting inflation will cause some pain. This was the headline after the Jackson Hole speech. Last year, the headliner was Wall Street closes higher after Fed Chair Powell delivers a Goldilocks speech. And I'm sure this year the headlines are going to be even more bullish. Because as I have mentioned before, Fed Jerome Powell is going to make it unequivocally clear the fight is not with inflation anymore. It is with the labor market. It is with the economy and trying to stabilize economic activity before it's too late. And we did hear from Fed Kashkari today, which in recent months, he has been one of the most hawkish Fed officials. Fed Kashkari says the debate about potentially cutting rates in September is an appropriate one to have. He also says inflation is making progress and the labor market is showing some concerning signs. He also says a weaker job market should open the door to a September cut. And I think this is all a pretty good preview of what to expect from Jerome Powell this Friday, especially this, again, from Fed Kashkari. The balance of risks have shifted more towards the labor market and away from the inflation side of our dual mandate. And as I've explained many times now here on this channel, the main thing to watch for and what will really decide what happens to equity markets ahead is the economy. It is the economic data. If the economy gets worse, stocks will get worse. If the economy continues to trend okay or get better, stocks will do well. And I think just thinking about stocks, we always think about the S&P 500. Well, in fact, you could actually see the data just trend okay and the internals of the markets get better. Thus, you could really start to see a rotation out of some of your big tech names into high-paying dividend value stocks, into growth stocks, into stocks that are leveraged to rates. And you're actually starting to see a little bit of this today. The equal weight S&P is outpacing the weighted S&P. The RSP is up 0.61% at the time of recording this video, and the SPY is up 0.51%, a 0.1% outperformance. It's nothing too dramatic, but I'm expecting you could see this kind of outperformance, slight outperformance, for months. Meaning we're not going to see the Russell take off like we did a couple of weeks ago and leave everything else basically behind. Big tech didn't participate. They actually sold off. S&P did really much of nothing during that time. You're not going to see anything that dramatic, but you're going to see a slow continued outperformance of the equal weight of, dividend stocks, of value stocks, of growth stocks that are leveraged to interest rates compared to big tech. Ryan Dietrich points out something that I think you need to know. The S&P 500 is up 7 days in a row and up nearly 7%. This is the best 7-day win streak since, get this, March of 2003. Strength like this isn't consistent with bear market rallies, but healthy bull markets. Up 7 days in a row and up more than 6% during a streak. You might ask, above average returns across the board with a 12-month median return of 17.5%. So for any of you guys that are bullish out there, this is a pretty reassuring sign. And if the average return for the S&P weighted index is 17.5%, just imagine what small caps and some of your stocks that have not participated in our markets are going to do over the coming months and subsequent year. We did get some data that came out today. This was the July Conference Board Leading Economic Index, negative 0.6% month over month, versus the estimate of negative 0.4% and versus last month's negative 0.2%. So this came in worse than expected. And it's been pretty bad for a while. It has definitely improved from some of the lower points you've seen at the beginning of 2023, but it's still not great. Goldman Sachs says for the fourth consecutive month, the US LEI has not signaled a recession ahead. LEI, leading economic index. That is the chart you just looked at. And I mean, I think it's right on that kind of borderline level. Like, in all fairness, I don't think this is signaling things are great either, or that we are going to definitively avoid a recession. This data did come in worse than expected today. Seth Golden says only a month ago, the Whaley breadth thrust took the SPX to all-time highs. Just a reminder that only one Whaley breadth thrust since 1960 has produced a cyclical top. Odds the top are very, very low. Carl over on X says the SPX hasn't had an 8-day win streak since November of 2023. It could happen today, in which it looks definitively that did happen. The past 4 years that had an 8-day win streak during the year that did this. 2013 was up 29.6%, 2017 was up 19.4%, 2019 was up 28.9%, and 2021 was up 26.9%. Year to date, we're currently only up 16.4%. So this would be the lowest yearly return if markets closed at today's prices by the end of the year. But again, I don't think the performance is going to be carried by big tech, especially if we get the economy that continues to hold up. The Fed starts to reduce rates. Odds of a recession could drop from here. That's not good for big tech. That is good for the rest of the markets, interest rate sensitive, dividend, value, growth, but not good for big tech. Or shall I say not as good, because big tech has been enjoying these risk-free returns of 5%, boosting that bottom line with subpar growth rates compared to other growth stocks. They're deemed as recession resilient. You can start to see how good events transpiring over the next couple of months could actually be a negative for big tech and bullish for, well, the rest of the markets. So I firmly agree with Tom Lee's call for the Russell to outperform your big tech peers. Tom Lee shares this from Coop on X. He says, summer ends September 20th. We still have a month for the summer of small caps. IWM is going to rally, and I'm here for it. And this is the clip in which sparked that conversation.
The market had been whipsawed by data point to data point, as you guys were recapping. You know, the jobs report raised recession fears, big risk off. Then we got inflation this week, which was pretty tame, and I think markets suddenly went back to thinking about liquidity coming into markets. I think that the data dependence of the markets and the Fed is very tough for investors. And I think if you look ahead, I'd say we always know the summer is tough. Summer probably runs through October, but I don't think that anything's changed into year end, which should look pretty good.
But are you lower conviction now than you were 2 weeks ago?
No change in our conviction, but it is just recognizing August historically is a tough month for markets. I mean, one thing that maybe investors can be encouraged by is since 1928, the most common month for the summer low is August. And the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
Now, Fundstrat posted this on their X account today. Of the 465 companies that have reported so far, 93% of the S&P 500. Overall, 81% are beating estimates, and those that beat are beating by a median of 5%. Of the 19% missing, those are missing by a median of negative 5%. On the top line, overall results are beating estimates by a median of 6% and missing by a median of negative 5%, and 59% of those reporting are beating estimates. Another big thing to watch this week, according to Liz Young Thomas, she is the head of investment strategy at SoFi, is preliminary annual payrolls revisions. They get released on Wednesday, covering April 2023 through March of 2024. Economists expect jobs added to be revised down by as much as 1 million. So if we're expecting 1 million downwardly revised jobs for the last year or so, if that even comes in at 800,000 revised down, that's still better than expected. And just in case you think you're behind, here are the average 401k balances per Vanguard. Under 25, $7,351. 25 to 34, $37,557. 35 to 44, $91,281. 45 to 54, $168,646. 55 to 64, $244,000. And 65 and up, $272,000. And a good point that Tom Lee made during that clip we just showed a couple of minutes ago was global liquidity. It is starting to increase. We've seen these similar patterns in the past where global liquidity increases and stocks perform well. And if this cycle does play out as normal cycles do, and we see a much larger increase in global liquidity, that could mean, well, a strong market, or at least a backdrop to support a strong market. Ryan Dietrich posts on X, the Bank of America Global Fund Manager Survey saw big positioning into bonds and out of equities last month. And I do think that's why you're going to see a very volatile market, because, I mean, you saw downwardly, revised exposure more than 20 points lower to equities. If you do see the data come in better than expected, you're going to get a lot more positioning back into equities again. Evercore says earnings growth and upward revisions have been broad-based across nearly every sector for the first time in 5 consecutive quarters. Year-over-year EPS growth expanded from the Mag 7 to the S&P 493, and that is going to support markets. Quote, in each major downturn dating back to 1990, S&P 500 earnings growth has turned negative on a year-over-year basis in advance of the official recession mark, but current trends in both revenue and profits look decidedly mid-cycle, according to BMO. And this is what BMO's Young Yu Ma just said on CNBC. This clip is titled, "Rate Cuts May Have Stronger Impacts on the Market Than the Market is Pricing In."
Stick with markets and where to find value as the major indices come off their best week since November of last year. Joining us now, BMO Wealth Management CIO, Young Yu Ma. Young, thank you for being here. So one thing I thought was really interesting in your notes is that you say that the Fed rate cuts are coming and the positive impact of those may catch the markets by surprise. You say that the economy is likely much more sensitive to rate cuts positively than it was to rate increases on the negative side. Why is that? Why isn't it symmetrical in terms of impact?
Yeah, thanks, Leslie. It's great to be here. We do think there is a lot of pent-up demand. So we think that the rate cuts are actually going to have a much stronger and favorable impact probably than the markets are pricing in now. Maybe not the first rate cut, but after we get 75 basis points, 100 basis points of rate cuts, we think there's a lot of pent-up demand lurking beneath the surface. Companies have heard a constant drumbeat of recession fears for about 2 years now. And along with that, dealing with higher interest rates, now dealing with policy uncertainty from a policy level at the government level. But once all that is alleviated, we think that a modest amount of rate cuts is really going to set in motion some of that pent-up demand and allow for spending by corporations to get back into growth mode, which is where they're looking to be now that corporate earnings remain healthy and the economy remains healthy, and this fear of recession is clearly going to be in the rearview mirror at that time.
In the meantime, would it be fair to say that you do expect volatility as we kind of get more into this election cycle, as we do get into kind of seasonally weak months of the year?
Well, there's certainly potential for volatility. Obviously, as we saw 3 weeks ago. And if we look historically at the past 2 election cycles, 2016, 2020, September and October were definitely choppy months with some weakness. And right now we do have a lot of policy uncertainty. The spectrum of potential political outcomes ranges from all the way from a Democratic sweep to various forms of a divided government to a Republican sweep. So I think companies are probably going to be on hold a little bit with those expansion plans until there's a bit more policy clarity. But again, we think that lurking underneath the surface with just a modest amount of rate cuts, policy certainty, these recession fears behind us, really sets into motion a very favorable dynamic in the market.
All that said, Young Yu, looking at top sectors for the month, let's say, on a 1 month basis, utilities, healthcare, staples. What do you make of this sort of defensive crouch we've been in, given what we've seen the last couple of weeks?
Yeah, it's partially defensive. I think that's true. But also, if we look at utilities is also a very strong growth play in terms of AI spending and data center spending. Utilities is actually the only sector that's been in the top 3 leading sectors for both the past month and on a year-to-date basis. So I think the market is telling us something there, that growth is likely to continue. Those other sectors, I think that was more of a retrenchment, sort of a pause in the marketplace where some of the growth names that have led much of the year had some consolidation, but I do think that pause is probably going to be, it's been reversed in the past couple of weeks, but by the end of the year, we think that's going to be behind us, and it's really the more cyclical sectors that are probably going to stand out.
Finally, got the dollar index below 102 now. Some pieces on the tape last week about the carry trade that did cause so much disruption, maybe finding some new life. Do you worry about a repeat of 2 Mondays ago?
Well, it's always possible. There's a lot of money still in that carry trade, we believe. But as long as it unwinds at a modest pace or stays stable, we don't think it's going to cause too much disruption. The problem would come if there's a big dislocation in the market at the same time you're getting unwinding. But I think even if we had that, what we would find is it's more likely to be a buying opportunity than a cause for medium-term or longer-term concern, just the way that we had a couple of weeks ago. So we're not overly focused on that, but should it happen, I think we'll be looking for opportunities rather than looking to shy away for the market for fears that it's a greater retrenchment.
Yeah, buying on more of a technical unwind as opposed to something more fundamental, as we now know in hindsight. Young Yu, thank you.
There was also this report out today from the New York Fed that shows a new low in employment, worries about finding work, and dissatisfaction with pay. A New York Fed survey released Monday showed that those who were employed at the time of the last survey in March, 88% still had jobs. The lowest in data going back to 2014. So 12% of these individuals that were surveyed previously in March are now unemployed. That's crazy. Those who expected to become unemployed rose to 4.4%, a 0.5 percentage point increase from a year ago and the highest in the survey's history. Overall, people are expecting to work longer, and most of the disparity was pronounced among women, those without a college degree, and respondents with household incomes less than $60,000. So conclusion really is people are struggling, especially middle income to lower income individuals. Here today, 10-year Treasury yields are trading down 3 basis points heading into bigger events like Fed Jerome Powell on Friday. I think this is appropriate. 10-year Treasury yields are at 3.86%. CNN's Fear and Greed Index is hitting the highest level you have seen in the last couple of weeks, back to where we were about a month ago and also where we were a year ago, sitting at 40, which is getting closer to neutral, but still in fear territory. Market momentum is in greed territory. Stock price strength is fear. Stock price breadth is neutral. Put and call options is greed. Market volatility is neutral. Safe haven demand, extreme fear, and junk bond demand also in extreme fear. Option activity in the SPY today is showing 24 different trades totaling $3.03 million with a positive order value of 39%. Now the RSP, which is the equal weight S&P, looks a lot better. Call open interest sitting at 73.67%, put open interest at 26.33%. The volume today on the call side is 82% calls and 17% puts. And here today, it's still a toss-up whether or not we get 25 or 50 basis points coming September 18th. We have 4 weeks worth of data still left to get. If the data gets worse on the economy, you're going to get 50 basis points. the Fed will try to thread a 50 basis point cut as not being a panic cut, as being something that they should do. Best case scenario is really a 25 basis point cut, and that would be even if the economy continues to be strong. Markets are pricing in a 77.0% chance of a 25 basis point cut and a 23% chance of a 50 basis point cut. By December 18th, we are pricing in technically 4 rate cuts still, with the odds of that at 43.3%. The odds of 3 cuts sits at 41.4%. So we are still pricing in a 50 basis point cut at one of the next 3 Fed meetings. But really, as I have said before, I think looking at, let's say, the SPY or the SPX that is market cap weighted is probably going to give you lower returns in coming months than an equal weight S&P or the Russell 2000, again, because the areas that control the SPY, about 40% of the SPY is Microsoft, Google, Apple, Amazon, Nvidia, some of these areas that have done very well, that have benefited from the Fed staying higher for longer with higher odds of recession risk. Really, there's been a crowding in these names. We all know this, and there's been a lack of love, if you will, in other areas of the markets. If we do see the Fed start to cut rates, if we do see the economic data come in okay, you will start to see the other areas of our markets really outperform, especially given the growth rates year over year for EPS, for the Russell, for the equal weight S&P are going to start outpacing the market cap weighted SPY. And that's another, I guess, fundamental reason to be bullish on the rest of the markets, not just big tech. Of course, do you want to sell all of your big tech? Probably not. But I think exposing yourself to other areas makes a lot of sense. Again, that is high dividend paying value. Anything that's 3, 4, 5% dividend yielding with a safe dividend makes a lot of sense right now. As the Fed lowers rates, then those higher paying quality dividend stocks become a lot more attractive, and I expect they will go up in value and the yields will fall again as the Fed starts to cut rates. So over the next 1 to 2 years, I think something like a CVS is going to do well. Something like some of your more stable healthcare companies will also do very well. Small caps are going to outperform, outpace. That's pretty much a guarantee as the Fed starts to cut rates. Industrials, a lot of consumer cyclical companies, if recession odds do fall, will also outperform. So I think there's a lot of value in our markets, just not in the headline S&P as much, and definitely not in big tech. But basically everywhere else, there is value to be had. And I would say I'm not super bullish on the SPY on a headline basis, but I'm very bullish on the rest of the markets as long as we are heading towards a soft landing. If the data gets worse, markets will get worse. And I don't know. I'm not a fortune teller. I don't know what the data is going to do over the next couple of months, but I do know the consumer's in a pretty rough place. If we respond well to the Fed cutting rates, and that does boost some spending activities, that will definitely be seen as a positive for markets as well. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.